Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has a PhD in economics. He's the author of Escape from the Central Bank Trap, Life in the Financial Markets, and the World is Flat. He also is a professional money manager, and he writes articles which I really enjoy for the Mises Institute. So he's an Austrian school economist as well as having a PhD in economics, which is pretty rare. Plus, he manages money in Europe, so he's got a very unique perspective on markets, combining the Austrian research and insights with actual real managing of money. Daniel LaCalle, thank you for joining me again.
Thank you so much. Always a pleasure.
So, Daniel, I want to get your view on the global economy. So there's a lot of crazy cross currents going on now. What do you think has happened? How would you describe the global economy in the last 10 years and where we are now?
Well, if we look at the last 10 years, the global economy exited the financial crisis with fake policies. So basically, it exited the financial crisis by hiding risk under central bank balance sheets. If we look at the increase in debt that we have seen since the financial crisis in the last 10 years, global debt has soared to more than 300% of GDP, which means basically that what we have basically done throughout most of the large economies is to get the economy a boost of monetary policy and a boost via low interest rates that has incentivized GDP growth via higher debt. However, the amount of debt that has been accumulating is significantly higher than the gross domestic product that was created with that debt. So basically, after the initial impetus of this massive monetary stimulus, $20 trillion injected in the economy, interest rates brought down to zero, in general, increase both in government and private debt, what has ended up happening is that the diminishing returns of new units of debt are very evident. And what we're seeing right now is a very significant slowdown in the global economy. We are also seeing that we have definitely had a prolonged period of expansion, but that it's also been a period of expansion in which the rate of both nominal and real GDP growth has been much slower and weaker than previous recoveries. So we've had a very fragile recovery fueled by debt, in which very low rates have sort of perpetuated the imbalances that were built into the economy into the financial crisis. And what we have right now is the diminishing return of those demand side policies. So monetary stimulus, fiscal stimulus, and low rates are generating less and less returns. Growth is slowing down. Capital expenditure is slowing down because overcapacity has been perpetuated. And additionally, what we see is that productivity growth, which is a critical factor of the health of an economy, is also extremely poor.
How important do you think the dollar is on the global economy? Because I've heard you and other experts talk about this massive amount of dollar-denominated debt in emerging markets. We know that China now has a huge credit bubble in the last 10 years, and they have a massive amount of dollar-denominated debt, trillions of dollars. And so do you think then that the global economy cannot handle a strong dollar? It seems to me that after 2008, a lot of governments outside the United States and a lot of corporations outside the United States were all betting on a weak dollar.
Absolutely. Yeah, well, it's not that the global economy cannot handle a strong dollar. It is that the global economy has been geared towards a weakening dollar, assuming that weakening dollar would come from higher money supply, and that it would come also from lowering interest rates, and that that would ultimately be inflationary, obviously, in commodities, because commodities are denominated in dollars. If you have a weak dollar, commodities go up in dollar terms, and that would help the emerging markets that usually produce those commodities. And the weak dollar as well would be would help inflows of capital outside of the United States and into the rest of the economy. So it's not that a strong that the world economy cannot function with a strong dollar. It's actually the opposite. A strong dollar has actually been a fabulous driver of growth in innovation and investment in the global economy, precisely because the largest economy in the world, the United States, via higher purchasing power of the dollar, was able to drive stronger investments to the rest of the world. However, when the way in which you gear the economy is by saying, I'm going to take mass amounts of US dollar denominated debt, then obviously you think that you're taking a bet. It's almost like a massive hedge fund outside, no? That is taking one single bet, which is that the dollar will weaken, inflation will rise, commodities will rise, and all of that will sort of pay back that massive amount of debt that has been incurred. So it's not that the global economy cannot live with a strong dollar, is that the global economy thought that it would be a fantastic idea and a wrong idea. It's like having a massively wrong trade. You decide that you're going to bet against the world reserve currency, losing its purchasing power relative to everything else, not just commodities, also relative to, let's say, European currency, the Chinese currency, etc. That bet had a big mistake, which is that all other central banks were doing exactly the same as the Federal Reserve, even worse, as you see in, for example, the People's Bank of China policy, or Japan, even the European Central Bank, and obviously central banks in Argentina and other countries. They were incurring into massively larger imbalances and massively larger increases in money supply than that of the United States. So the world of currencies is a world of relatives, and the world of monetary policy is also a world of relatives. So it's not about who wins, it's about who loses. And if you look at what has been going on, is that the entire economy of many of these other non-US economies, what they were doing is to have one massive trade, one massive bet, which was the US currency is going to devalue, the US the purchasing power of the US dollar needs to come down, and I'm going to leverage my bet, my economy, just like a hedge fund would do, on that outcome. Now, obviously, if you leverage, imagine a hedge fund that decides to go massively short, tech companies, no? And it's not just the loss that you make on the trade; it is also the loss that you make on the leverage of the bet. And the leverage of the bet of the rest of the economy was huge, because the diagnosis of what the first batch of QEs that the U.S. undertook after the financial crisis would deliver was wrong. Was that everybody believed that QE would deliver high inflation, high growth, high disruption of purchasing power of the U.S. dollar, and what you saw was low inflation, low growth, and the reserve currency status of the U.S. dollar strengthening. Why? Because everybody else was doing the same mistakes, but without the strength of the U.S. economy.
And it seems that a lot of flight capital, and I think the emerging markets did not expect this. A lot of flight capital actually came into the U.S., and that's why asset prices in the U.S., real estate, stocks, bonds, has benefited even, and this goes to like part of Brent Johnson's milkshake theory that the U.S. wasn't doing QE and it was attracting all the capital. They were benefiting from these other countries, like you said, doing even worse than what the U.S. has been doing the last, I don't know, since the QE ended and the Fed switched to QT.
Absolutely. Think about this. The capital flight from emerging markets, from China, comes fundamentally from domestic savers and domestic investors. That capital flight doesn't happen by coincidence or by mistake or because they are unaware of what is going on in the economy. The reason why people are moving capital outside of their country into the United States is because they have the certainty that the monetary policy of their domestic central bank and their domestic government is much more detrimental to maintaining the purchasing power of the currency and maintaining the value and of the assets and the wealth that they own than that of the United States. And this is a critical point in terms of analyzing monetary policy. We all understand that the Federal Reserve does commit mistakes, does make mistakes. No? We all understand that the Federal Reserve policies can be damaging in some parts of the economy, but there's one central part of the Federal Reserve's monetary policy that almost every other, I would say 100% of every other central bank ignores, which is to have an eye on the secondary market and on real demand for the currency, i.e. maintaining reserve currency status. So in essence, by what the Federal Reserve created with QE was almost the effect of a negative subsidy on the rest of the economy, on the world economy. On one side, it generated a strong increase in money supply, but there was a strong increase in money supply from assets that, relative to the rest of the assets of the world, investors, savers, and governments of the rest of the world perceived as more attractive. And as such, once the mirage of growth and the mirage of inflation did not appear, because you were basically perpetuating overcapacity all over the place, actually exporting overcapacity like China did to the rest of the world, what ends up happening is that the unit of currency that you're holding elsewhere in the world, you feel that it is safer in a US dollar. It becomes sort of like a gold. It becomes sort of like a reserve of value relative to your domestic currency. That is critical, and that is a critical mistake. That the worst thing that central banks can do is to believe that they can conduct the same policies of the Federal Reserve without thinking about secondary market and reserve currency status.
So in the last couple months, the Federal Reserve has been talking about rate cuts, and despite that, the dollar index, it hasn't collapsed. We're recording this interview on Tuesday, July 16th. The dollar index is still over 97. It looked like it was sputtering a little bit a few weeks ago, around 96-ish, and then it started to rally on the Fed comments, probably because of what has come out from the European Central Bank.
Absolutely. This is, I always tell to my students in a sort of like a bit of a joke, imagine that the world is a gym class. If everybody's fat, nobody's fat. You see what I mean? Huh? If everybody's 100 kilograms. And this is what is going on, is that the dollar index is not coming down as so many of mainstream economists and the IMF, maybe so many people that have this mirage view about monetary policy. The dollar index is not coming down because everybody else is making the same things. So when the European Central Bank says that it's going to maintain negative rates for a lengthy period of time. It's going to continue to purchase maturities of assets. It's going to continue to inject liquidity in the economy. What it is basically doing is damping any of the weakening effect on the dollar that the Fed would have achieved if everything else remained equal by saying that it would cut rates. So you see, what happens on a global basis is that you can almost think that everybody, all of the central banks, expect the Federal Reserve to weaken massively the dollar and increase massively money supply, but they don't receive the effects that they would like, which is currency depreciation and inflation, because they are all doing the same thing at the same time.
Yeah, the other thing I think they've stupidly done is they've massively overborrowed in dollar-denominated debt. So the emerging markets have, over $10 trillion in dollar-denominated debt. China has, according to some estimates, it's well over $3 trillion in dollar-denominated debt, and I think $1.2 trillion is coming due in just the next 12 months, which is a large chunk of their reserves.
Absolutely. So basically, think about this from the perspective. This is like think about this from the perspective of the world. You know? You have on one side a massive hedge fund called the rest of the world that is taking a leverage bet on the U.S. dollar weakening. You have another massive hedge fund, which is the Federal Reserve, trying to weaken the U.S. dollar. Let's be honest about that as well. But if everybody needs to constantly pay the margin call, which is what you've just mentioned, the maturities that continue to come overdue, the reality is that you, by committing those mistakes that you have committed of increasing massively debt in U.S. dollars, and therefore you need to constantly purchase dollars, and therefore you contribute to the strength of the dollar, despite the fact that even the Federal Reserve would like it to weaken. I.e., the demand for dollars is higher than the supply, even when the supply grows.
That sounds very perverse. So a lot of people, very smart people, were betting on a weak dollar, and the exact opposite has happened so far.
Yeah, because in order for that bet to work, you would have need to bet that the entire world would change its view about what is a world reserve currency. And this is what very few people like to acknowledge. Not that they don't understand, but they don't like to acknowledge. They don't like to acknowledge the fact that if you go with 100 euros or a few hundred yuan, or you name it, you name the currency, anywhere in the world, the probability of not receiving the goods and services that you would like to purchase with that currency is vastly higher than if you go with a few $100s. You go with a few $100s to, I don't know, IKEA in Nigeria, and you're going to get food, and you're going to get clothes. I bet you. And you go with a few hundred yuan or a few hundred euros, I'm not entirely sure. I'm not only not entirely sure, I'm entirely sure that you will very likely get nothing. And this is not something that you change by design. And this is the problem of central planned monetary intervention, is that people believed that just because we don't like what the Federal Reserve is doing, the rest of the world will like what the PBOC, the Bank of Japan, or the ECB is doing. And obviously, you can tell me, well, that the yen is strengthening. What is the yen? The yen is a distant cousin of the dollar, because Japan is a massive saver of U.S. dollars. It's a massive purchaser of U.S. dollars.
So I want to transition now to, you talked about central planning. I want to get your thoughts on China. So it seems to me that there's still a lot of people that are very, very bullish on China, and when I talk to them and I try to bring up the credit bubble, how quickly they've grown credit, how quickly their money supply is growing. Their excuse seems to be that China owns a lot of gold, they're buying a lot of gold, and that their credit bubble and their money supply growth doesn't matter. So what are your views on China then?
The first thing is that it's ludicrous. Even if you multiply by 10 the official figure of gold reserves that China publishes, it's not even a fraction of its money supply. And it's not even a fraction of all of the gold that it's buying, which it is obviously buying quite a lot of gold. All of the gold that it's buying is not even a fraction of the growth in money supply on an average year. It's just almost double digit. So the first concept is that from an Austrian perspective, that it tends to come from an Austrian perspective of sound money, is that China has absolutely nothing to do with sound money. China's monetary policy is the Fed on steroids without the secondary market of the United States. There is absolutely, if you dislike as an economist or as a trader or as a casual study of a student of economy, if you dislike the monetary policy of the United States, you should be absolutely appalled of the monetary policy of China. That is because on top of the lunacy that is massively higher money supply growth, massively higher monetary injections, constant refinancing of bad debt. Not only that, you have capital controls. So there is absolutely nothing that somebody that defends sound money policies can be intellectually honest and say, I defend the Chinese policy. The Chinese policy is exactly the same as any other fiat currency. However, it is much more geared because it's central planned, because its main objective is not just a little bit of controlling prices, a little bit of inflation and employment. No, absolutely not. Its main objective is perpetuating the imbalances that are built into the economy at any cost. And obviously by that, it needs to have capital controls. Think about it from this perspective. Any of the defenders of China, of China's monetary policy, there are many beautiful things about China. I love China in many, many things, great things about it. But we're talking about monetary and government economic policy. If you defend it, explain to me why it has capital controls. Because if it's so great, and if the monetary policy is so sound, and if the yuan is gold-backed, why do they have capital controls? Why do they need to stop currency outflows and capital outflows? Because if you would really be sound money driven and gold-backed, you would have no need for capital controls because the inflows from the rest of the world into China would be phenomenal. Actually, you would probably face a situation of having to go almost like Switzerland and control the rise of the yuan. But it is not true. And the reason why it maintains capital controls is because the citizens of China that are the first ones, like the citizens of Argentina or the citizens of Turkey, that want nothing to do with their domestic currency because they know that it is not undervalued or gold-backed. They know that it is significantly weaker than most other fiat currencies, and on top of it, if at any moment the capital controls are lifted, there would be a flood, an absolute flood of capital out of the country.
Yeah, there's a lot of worrying data points about China. They have 300% debt to GDP, depending upon how you measure it. They have, almost $50 trillion in credit. They have an enormous amount of dollar-denominated debt. Their money supply has increased. Trillions of dollars, in my opinion, misallocated capital. There's buildings that as soon as they're built or before they're built fall apart, or they're not tons of buildings and houses that are not maintained properly. There's no reinvestment. and then at least 50 million, according to some estimates. Some estimates say over 65 million empty homes. So that to me, as an Austrian school economist, sounds like misallocation of capital. And then I get in arguments with all these people in the gold community and even some Austrian school economists who are not aware of all the details of China. I think Peter Schiff is one of them, that they say it doesn't matter as much because China's saving and China's manufacturing and China's buying gold.
But this is you see, you can have all the gold you want. You can even have 100% of your money supply in gold. But if your credit growth goes to misallocation of capital and the economic added value of that credit creation is negative, you're still going to destroy the currency. You see, this is what we sometimes fail to understand, is that the economy does not get better simply by having some gold. It might support at some level the currency, but it is not the only driver. It's not the only driver at all. You have to have a level of allocation of capital that participates in the creative process of credit growth, i.e., that the economic added value of credit is higher than the money creation. So it's a virtuous circle. The virtuous circle of credit generates higher growth. But if you generate higher growth via white elephants, as you were mentioning, if you have, as you do, a massive government-sponsored economy in which return over cost of capital is not a measure, in which real economic return. So it basically becomes, it is actually not even neo-Keynesian, it's beyond lunacy Keynesian, because because although there is a part of the economy that what they call the new economy in China, great, which is growing fast, has high returns, and that's not even a fraction, it's not even a fourth of the part of the economy that generates negative economic added value. So ultimately, what you need in an economy is that think about credit as food, as nurture, as something that is nurturing the economy. So if you eat
credit
food that is nurturing, that is healthy, that has a nutritious value, you can work harder, you can be healthier, you can live longer, etc., etc. Now think about the Chinese economy as a massive, and it is a massive empty calorie consuming economy. As such, it has to. Yeah. Sorry.
Yeah, I was going to add to your points there with your analogy about food. I was going to say that from a real estate investor's perspective, since so much of China's GDP and construction boom, normally real estate investors here in the United States and other parts, when they build a building or a house, they want someone to live in the house or to buy the house from them and maintain the property. And the point of using credit, Daniel, is normally to get more cash flow from it. And China's using credit to build empty buildings. They're not getting that increase in cash flow to pay back the credit.
Mm-hmm. And if you look at the number of companies in the Chinese stock market that basically get into increased debt to pay interest expense, or what we would call elsewhere in the world zombie companies, it is staggering. And from an Austrian, not even from an Austrian, even from a realistic Keynesian perspective, there is nothing about the Chinese economy that differs from the massive bubbles that we saw in Japan, that we saw in Spain, even in Sweden, or in Iceland. There is nothing different. Now, what makes it different? And this is the key factor, Jason. The reason why people believe that it will be different in China is one single reason, is that it's a communist dictatorship. And they believe that because the government says so, it will be like that. You see, we all understand that in an economy, in an open economy, none of these factors that are building, none of these risk factors that are building that you and I were mentioning before would ultimately lead to higher growth or lead to even a solution to the problem. However, the only reason why many people believe that in China it will be different is simply because somebody is going to say so from the Communist Party. Is going to say it'll be like this and it'll be like this because I say so. That doesn't work. It didn't work in the central. It didn't work in Russia, in the USSR. Sorry.
And China's much larger spending in central planning than the Soviet Union ever was. It's on a never-before-seen scale because they've had so much money come in from their trade relationship with the U.S. But the Chinese banking system, you talked about this as part of the command and control central planning. People were expecting a full bailout. And now with this news of Baoshan...
Think about
Go ahead.
You've nailed it. You've absolutely nailed the concept in the head. What the bulls of China are betting on is that the government will always bail out the imbalances of the Chinese economy and that the productive economy will offset all of those mistakes and all of those imbalances. But anyone in economic theory, in history, in reality, knows that if you have a system that incentivizes debt and incentivizes unproductive investment, and you bail it out, fund flows go to that part of the economy, not to the other. You see what I mean? If you tell me that if I make a mistake, you're going to bail me out every time, I'm going to make mistakes. I will make them big, by the way. I will make them huge.
And that's why you have so many Chinese companies now that have gotten into real estate that have nothing to do with real estate, and they've gotten into the construction boom the last 6 to 8 years.
Yeah. And look, I'm Spanish, and I've lived the Spanish real estate bubble. It's still, the country has not yet recovered from it. I've seen the real estate bubbles of Iceland. I've seen it in Sweden. I've seen it in Japan. The idea that the real estate bubble, or any bubble that is as large as the imbalances that are built in the Chinese economies, are going to be absorbed quietly, and in the meantime, the really productive, the really economic added value economy is going to creep up and offset it, never happens. And it never happens. And it happens even less if you have a central planned constant bailout program.
Well, I can't see them continuing to do bailouts and allowing this credit bubble to keep growing and their money supply to keep growing without destroying their currency.
Absolutely. That's why the key question to the China bulls is remind me, please, why they why they tighten capital controls. It's a very simple question. If you're a Keynesian, doesn't matter which school you come from any school you come from, if your economy is stronger, if your economy is better, and your monetary policy is sound, why do you need capital controls and tighten them?
Yeah, there's just so many warning signs or red flags now in China. People were expecting full bailouts with Baoshan Bank, and then here we go, the Chinese government, the People's Bank of China announces 30% haircut. So there's going to be a lot of pain that people were not expecting in the banking crisis, and we don't know if they're going to start release any more of the names of the banks that fail.
Yeah, and the other thing that adds to the myth and the mirage of China is misinformation, is that unlike the other presidents that we've talked about, unlike Iceland, unlike Sweden, unlike Japan, unlike Spain, and like the UK, you name it, unlike the US, your ability to understand the true extent of the problem is very little. The first thing, again, coming back to those people that say that, that everything is great in China. If everything is great in China, why is it impossible to have a clear analysis of non-performing loans in the country? No, so everything is great, and the banking system is fantastic, and there's no problem whatsoever. You would encourage that level of transparency because you have something to flaunt, no?
Yeah, I would think so. I think that
Absolutely.
They want to brag that things are going well.
Absolutely. More importantly, if you want your financial system to be a model for the rest of the world, and even enter into mergers and acquisitions all over the world with your banks, you want your banks to be seen by the rest of the world as absolutely pristine, transparent, and having the best solvency, liquidity, and capital ratios in the world. However, you don't. Interesting that. Yeah? So, and obviously you can say then, and this is the problem with China bulls, in my opinion, is that you enter into imagination theories. No, imagination theories are, but the real gold reserves of China are unknown. Well, explain to me why you would make them unknown when you have capital controls. So if you think that your currency and is so engraved in sound money that your gold reserves are outstandingly and significantly higher, explain to me what's the rationale behind saying that they're 10 times lower. It's like, imagine, think about it from this perspective. It's like thinking that you're going to go to the world. This is a credit world. That you're going to go to a bank and you're going to ask for a massive loan and hide your true wealth and your true and the true value of your assets, expecting the bank to lend you more. It makes no sense.
Yeah, the bank won't give anyone a loan without proof of income, putting down collateral,
Absolutely.
sometimes even signing over your house now in the United States.
Yeah, absolutely. What do you do? What do you do if you want more credit from a bank? You flaunt. You go. You go with your best clothes and your best car, and you go and you show your best. Your best of your assets. So somebody has to explain to me what is the rationale behind an economy, China, that wants to have massively more credit from the rest of the world, but decides in the process to hide key aspects of its true wealth in order to get more credit. Makes no sense.
So would you say that China's acting like an emerging market? Because I'll ask you this about Kyle Bass. I think Kyle Bass is one of the smartest people in finance. He's not always right. He's been taking on governments with his trades lately. But he thinks that China's running a current account deficit, and China's basically turned into an emerging market very similar to what happened to Argentina and Turkey. So what are your thoughts on China and running in a current account deficit?
No, I agree with him. China is running a current account deficit with almost every trading partner they have except the United States. Now, the massive trade surplus that it has with the United States is fundamentally coming from the fact that 70% of its intellectual property and software are not being paid for. No? So what ends up happening, and these are figures, this is around 600 billion of net loss to the United States. So ultimately, if you look at all the components of the current account, China, in fact, is actually behaving exactly like Argentina when it made this false equivalence of the peso to the dollar. You remember? If you remember what Argentina did, what it was basically doing was to hide its monetary and fiscal plus trade imbalances by pegging the currency to the dollar at an exchange rate that was completely unrealistic. And by doing that, it generated the perception of strength, while what you had behind it all was building a massive imbalance that ended up with a currency crisis. In my opinion, obviously with numerous different differentiated factors. I'm not going to enter into them, obviously, but in the core of the practice, China is behaving precisely like that.
So we've discussed China's reserves before. I think China is planning to have around $3 trillion worth of reserves. Mm-hmm. People who are bullish on China and defend China say that that's plenty of money. They still have plenty of money coming in to protect their currency, to pay off dollar-denominated debt. So what are your views on China's reserves? You told me that they're used as collateral, they're already tied up, and in the liquid investments. Is that your full position on China's reserves?
Well, my position on China's reserves is that, if you understand the credit cycle, the money supply cycle of China, is that those reserves are unusable. So the point is, no matter how you see it, China's reserves have fallen about 20% from the peak, and they stayed at about $3 trillion. No matter how you see it, to me, the reality is that most of those $3 trillion are unusable, are already sort of impossible to be used for any other purpose than to keep the status quo. However, the other point is that if you look at the dynamic of credit growth, money supply growth, and economic added value of that credit, it's even worse. Because basically, you've mentioned it before, I believe, in one of your questions. Basically, those $3 trillion would be consumed in very little time. I would say, you can say the number of years. It doesn't get to 3. It doesn't get to 3 years. It would be consumed if capital controls were lifted. And this is the critical part. The capital control part is the only thing that is currently keeping the mirage of China alive.
Yeah, it's really interesting. Kyle Bass and people who are friends with him and work for him tell me that China is manipulating their currency up, trying to prevent it from falling, because if the currency, the RMB, gets devalued against the dollar, that a lot of capital would flee China. So it seems that they're spending a lot of reserves trying to protect their currency from a big devaluation.
Think about this. There's a couple of things in China that are very unique. No? One of them is the massive amount of gold-backed loans, copper-backed loans, oil-backed loans, so commodity-denominated loans. So if you ask for a loan in China, it is quite expensive. It is not cheap. And as you know, as the credit cycle has deteriorated, loan sharks and the shadow banking is demanding higher levels of collateral. So a way for companies that are not doing well to get allegedly cheap debt is to back it with investments backed by the price, not backed by commodities, but backed by the price of commodities. So in essence, what you're basically doing is that you're borrowing in dollars guaranteed by an investment in something that needs the dollar to depreciate. So funnily enough, coming back to the point that we were making before, that in itself is a time bomb. And coming back to the point of Kyle Bass's team, I haven't had the pleasure of speaking with them or himself, is that how quickly those reserves would be consumed if that commodity-backed loans or commodity price-backed loan, I wouldn't say commodity-backed, commodity price-backed loans would be needed to be either refinanced or repaid. As such, for China, it is essential to keep its currency significantly higher than what it should trade at. And that is where we're at, and the reason why the yuan fixing is almost, tied every week by the government.
So I want to transition now to the European Union and the European Central Bank. Since you live there, you manage money there, that's basically your home base. There's a lot of craziness. The European Central Bank seems to have done more reckless things, in my opinion, than pretty much every single central bank over the last 4 or 5 years. You have recent articles out on the Mises Institute from June 8th that the ECB continues to incentivize reckless behavior, and this other more recent article from the end of June on June 25th, negative rates have damaged banks, but that is not the worst effect. So I've been researching this a little bit. I know I did take a look at your article. I know you've spent a lot of time on this. How much collateral damage has the European Central Bank done with their policies of negative interest rates and quantitative easing? Because when I hear the stories about the bond yield for Greek debt or Italian debt, and then I just heard that story that 14 European junk bonds are now negative yielding, this all sounds just insane to me, Daniel.
Yeah, and it is. And it is because the transfer of wealth from the productive economy into the unproductive economy is massive. And that is one of the reasons behind the stagnation of the Eurozone. Because remember, at the peak of QE in the United States, the Federal Reserve was never 100% of the demand for treasuries. There was always a secondary market. At the peak of QE in the Eurozone, the ECB was 7 times the demand. So the problem that it has right now is that it's stuck between a rock and a hard place. On one side, you have governments that have saved more than €1 trillion in interest expenses, but they have consumed it all in maintaining the imbalances. So if you look at, for example, the deficit reduction of the Eurozone, the vast majority of it comes from interest expense saving. But at the same time, structural reforms haven't happened. So what ends up becoming is a perverse incentive for governments to continue to perpetuate the imbalances. So Greece has not reduced debt. Greece's debt is 170% to GDP. Italy's debt is 130. Spain's is almost 100. Same in the case of Portugal is 120 or something like that. So what ends up happening is governments, they take credit for the reduction in bond yields as some sort of market recognizing how well they've done, which is incorrect because there's no market. It is the entire reduction of bond yields comes from the ECB policy. Remember that the ECB allegedly stopped QE, but has continued to repurchase all maturities. No? So if you stop QE but you continue to purchase all maturities, what do you do as an investor? You buy bonds. You buy. They're going to be repurchased by the European Central Bank, so I don't care. And what this generates is a massive credit transfer from the productive economy into the unproductive economy. So basically, because also governments in the Eurozone, with all of this money, what they have been doing is to mostly spend on current spending. No? There's very little investment. So the collateral damage, obviously, you can say, hey, mortgages are cheap, but house prices are unaffordable. And that is also creating a very tense environment in the Eurozone. You see it in demonstrations in Paris all the time, but not just in Paris, in many other countries. You see it in not just in France, but in Spain, etc. People are complaining about the cost of living, while the European Central Bank says that there is no inflation, obviously, because the cost of living is getting more and more complicated. And you don't have a dynamic economy like the United States. So it's not, you don't have a system in which the positive effect of creative destruction sorts things quicker. in the European Union, the non-performing loan portfolio remains almost stuck at 1 trillion euros and it seems unable to come down any further. And it's 3 times in terms of overall assets what, for example, the United States has. So, in essence, the solution of the Eurozone through monetary policy has been very similar to that of Japan, which has been to zombify the economy so that it doesn't hurt. Obviously, create some form of damage needs to happen in order to restore the imbalances created throughout the period. Those can come from a very fast-growing technology sector, which the Eurozone doesn't have. Those can come from a very fast-growing small, medium enterprise economy. That's not the case in the Eurozone. What the Eurozone is doing basically is to massively pump government spending.
So this whole policy by the European Central Bank, you talked about it benefiting governments because they pay less on interest because the Greek bonds, the yields that these governments are paying are way lower than the market rate in a free market that they would have to pay. But wasn't this policy supposed to benefit the banks? Because the banks were supposed to charge depositors, right? But It seems to not be benefiting the banks at all. The banks seem to not be benefiting from this. Their margins are being eroded. They're having problems making good investments with good returns now in Europe.
Yeah. No, it's massively hurting the banks. Banks' net income margin has collapsed. The return on tangible equity of the banking system in the Eurozone, bank by bank and as a sector, is way below cost of capital. And core capital has increased fundamentally through hybrid issuances of debt. So what is called COCOs, no? And similar instruments. So the banking sector has been massively damaged, but more importantly, has been taking more and more risk at lower and lower returns in order to maintain its business. So what we don't know so far is the extent of the risk that has been embedded in the loan portfolio of banks. We know, for example, that many of the banks moved their investments into emerging markets in order to get some inflation, some growth, and some improvement. But as you have seen with some of the Eurozone banks, exposure to Turkey, exposure to Mexico, exposure to emerging markets has actually been quite damaging as well. The Eurozone banking system has been doing phenomenally for a negative interest rate scenario. They have been the kings in terms of improving their core capital ratios, but that doesn't mean that they have solved their problems. It means that they have survived negative rates. Now the problem is if those negative rates remain, because what you're going to start seeing is taxing deposits, is negative rates for savers in many of the areas that are sort of safer, and increasing levels of risk taken in the balance sheets. So what I would say is that if you look at both sides of the monetary policy impact, the positive impact of monetary policy in the European Union has been to save the euro. The second positive effect has been to save government spending in interest expenses. The negative has been zombifying the economy, massively changing the allocation of capital from the productive sectors to the unproductive sectors, and hurting a banking sector that weighs too much in the Eurozone economy. Remember that the total assets of the Eurozone financial system are about 3 times the GDP of the Eurozone.
It seems that there's been a lot more negatives than positives what the European Central Bank has done, and yet Christine Lagarde, who's taking over as the head of the European Central Bank, is saying how successful negative interest rates were. But I just see so much collateral damage, Daniel. I see it from the insurance companies. I don't know if they plan on the insurance companies getting this hurt. Insurance companies need positive yield in the bond market to reinvest people's premiums. That's how they run their business.
Oh,
the float has to be
absolutely.
reinvested. So the insurance industry in Europe looks to me to be severely damaged, if not permanently crippled. And then people's retirement accounts, savers, investors, pension funds, those look damaged as well. And, you know, these lower rates, these are going to benefit the zombie junk bond issuing companies, the corporate debt companies. We talked about this, I think, last time you were on for an interview, how many Eurozone companies are issuing new bonds just to pay interest payments on their debt.
Yeah, absolutely. No, interest. Zombie companies have soared in the Eurozone. I do mention something that is very important. The Eurozone has a problem of population, has a demographic problem, aging of the population. You cannot combine, it's very, very dangerous to combine an aging population with the destruction of savings, because the pension liabilities that are mounting are going to be impossible to finance. And this is a factor that everybody willingly ignores, is that, yes, you are saving governments a lot of money in interest expense today, but you are massively crippling, as very well said, the pension system, the ability to pay and to generate income for an aging population, while at the same time, from a policy perspective, you say that there's no inflation, yet you have demonstrations all over Europe about the rising cost of living.
Yeah, I think the real-world evidence trumps the government statistics in pretty much every single government, that people are just being killed with currency devaluation, inflation, and taxes. And even if there is no inflation, these governments, because they've overborrowed, they don't want to cut government spending, they still layer taxes on. So even if there wasn't any inflation, governments are still wanting to tax more. Do you think that flight capital, Daniel, is going to come from these pension funds in Europe and insurance companies? Do you think a lot of flight capital is going to go from the European Union into the U.S.? I'm sure some of it already has, but do you think there's going to be a mass acceleration then as negative interest rates increase?
Quite well. It is quite likely that what you see, as you saw, for example, in Japan, is that you have a reverse capital flow. Currently, the capital flow is moving from the sovereign bonds into corporate bonds, maybe equities, within the Eurozone. However, Eurozone stock market, you look at the stocks, the Euro stocks has not recovered yet from 2016-17 levels. No? So a lot of the money starts to go to the United States. And why does it start to go to the United States? Because that's where you have three basic elements that you don't have within the Eurozone. The first is that you have a core inflation of around 2%, and therefore the yield on treasuries continues to be attractive, even after currency swaps, so even after the effect of currency and the effect of inflation. The second is buybacks in the equity market. Is that corporates within the United States have a much more total shareholder return driven strategy. The third is safer solvency ratios within the issuers in the U.S. market. It is true that corporate debt in the United States has grown. It is true that there are pockets of high yield risk in the United States. Absolutely they are, incomparable to the Eurozone. So, and why? Because the Eurozone made the mistake of willingly prevent the high productivity companies from growing in the Eurozone. and continues, therefore, to subsidize the least productive part of the economy to tax the highest productivity side of the economy.
So it seems to me that whether it's the Federal Reserve planning on rate cuts and eventually QE, Japan has been doing this longer than anyone else, and the European Central Bank is basically copying Japan, that the largest governments, China hasn't done this yet, but the largest governments in the West, including Japan, are all in this financial repression, Japanification game. Would you call this the negative rates? Would you call that stealing income and then stealing principal value from bond investors and savers? And because it seems that like the goal of this is an enormous wealth transfer to maintain the status quo for the government, and it was supposed to help the banks, but we've seen evidence now in the European Union it hasn't. But it seems that Japan thought it would help the banks, and the U.S. government wants to help the banks too.
Yeah. I think that obviously what you have is the recipe for stagnation, because when you have an entire economy that at its core is penalizing saving and prudent investment to subsidize or incentivize high debt and speculative investment, inflation or inflation-linked or inflation expected in the least productive sides of the economy, you end up having an economy that is working against that positive, that virtuous circle of credit. The virtuous circle of credit is reversed, and what you're basically doing is creating a bigger problem. And because it does not translate into a financial crisis like 2008, governments and central banks will continue to do it. But the flip side of not having a 2008 style financial crisis is stagnation and constantly trying to generate inflation while money supply growth continues to go up, yet money velocity comes down, and at the same time productivity growth worsens, is a devastating side effect with the middle classes and the general voter, is that discontent rises through the roof because salaries don't go up, because the access to household, access to goods and services is worse, or is perceived to be worse without taking masses of credit. And that's what we're seeing. And so it is the recipe for stagnation. Why? Because the overall decision of economic agents is being led to the least productive side of the economy, because it's the one that inflates GDP faster. You see what I mean? So
yeah, and
so you're inflating. You're basically perpetuating imbalances to keep GDP on a nominal and real basis as unchanged as possible. You zombify the economy.
Yeah, and it looks like savings and capital is being destroyed.
Absolutely, because money velocity comes down. The productive companies don't find opportunities to grow, to invest, and generate a decent return above its cost of capital. So what they do is either they buy back shares or they reduce debt, whilst the unproductive and inefficient companies say, hey, money is free, so I'm going to increase my exposure to the bubble. You see? So what you end up having is that you've had the most efficient companies have been improving their balance sheets, reducing debt or buying back shares, whilst the ones that are most least productive have been increasing their exposure via credit.
I was thinking more at the micro level, where people cannot get a return on their savings, so their standard of living is being their standard of living is being destroyed with stagflation and taxes. So they're having to dip into their savings more to maintain their standard of living, or dip into their savings to pay higher property taxes, etc.
Yeah, absolutely, because the fiscal side is extremely important here. On one side, you have the deteriorating effect of stagnation and how governments ignore the real cost of living. But on the other side, you have a constant erosion of disposable income via taxes to finance a government spending that is being artificially pumped up by low interest rates and high liquidity. So if you think about it, what it is basically destroying the very fabric of what generates improvement in savings and improvement in demographics and improvement in consumption, which is the middle class.
Yeah, and most people are not seeing a benefit from their tax dollars being spent, so they're not seeing directly the government spending benefit them. So that's another issue, and that's why you're seeing all these protests in France, and I expect more pitchforks, more angriness, more angry people escalating here in the United States as we approach the elections next year.
I think it's unfortunately very likely, and the reason why it's very likely is that when you have all of the mainstream politicians, governments, economists, saying there's no inflation, you already start from a very wrong premise, is that the average consumer can take a little bit more taxes, a little bit more inflation, but the average consumer is already heavily burdened with taxes. Remember that in the European Union, the average tax wedge on a household is 40%. So you're basically spending, and this comes with the idea that but you get free education and free healthcare. By the way, not true, because it's not free. You're paying it in higher taxes. No, you're paying it in advance, even if you don't use it. No, so what you end up having is this dichotomy in the Eurozone in which the middle class is being said, you need to pay more taxes because this pays for free healthcare, free education, but you don't use the free education because it's not very good, to be fairly honest, and you don't use they're free, and it's not free because you pay for it, and you don't use the free healthcare either, so you need to have a private provider. So it becomes a perverse system by which you say that you're promised an entitlement that does exactly. You're promised an entitlement that is not an entitlement. That is not something. That is not that you're paying.
There's no value to it.
There's very little value to it.
Yeah. Yeah, because if they're saying, well, you have all these things that are included for free, you'd expect them to be halfway decent or pretty good, and if they're below even a certain threshold, no one's going to use them.
It's not that no one's going to use them. They use them, but the results are substandard. No, and we're getting this. We're increasingly having a problem of education quality and education results in the public sphere, in the government sponsored, taxpayer paid education. We're also having a big issue in healthcare because everybody's talking about free healthcare and universal healthcare, while you have co-payment in medication, and you have an increasing requirement of having not just what you pay in Social Security for healthcare, but also to have a private insurance.
Yeah,
what Bernie Sanders doesn't get. This is what he doesn't get is that most people in the European Union end up paying twice for the same thing. It's not that they're getting one thing free. It's that most of the middle class, the vast majority of the middle class, is paying twice for the same things.
I don't think Bernie really cares. I think that guy's an enormous hypocrite now. He's a 1%er, so he rails against the banks and the rich people. He's a rich person now. He has how many vacation homes? He has a rich salary. He flies first class everywhere and doesn't want to talk to regular people anymore. So, Daniel, I want to thank you very much. I've kept you for an hour. This was a very interesting discussion. You gave my listeners a lot to think about. with your views on emerging markets, China, the dollar, and the European Union. If my listeners want to find your work, how do they do so?
Oh, the best way to find me is you can find me on my website. It's DLACALLE.com. That is DLACALLE.com. You can also find me on Twitter. It's at LaCalle_IA, DLACALLE_IA. And you can also find me on Instagram, on LinkedIn. Not very difficult. You key Daniel LaCalle. It's not very difficult to find me.
Okay, great. Well, keep up the good work with your excellent posts on Twitter and your Mises. I highly recommend your Mises Institute articles because you're a professional money manager, and one of the problems of the Austrian School of Economics is it tends to not focus as much on reality and more on theory, and I think you do a great job combining the two with the Austrian theory and also the reality of the economy that we live in every day.
Thank you so much, Jason. Always a pleasure. Thanks for having me.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to wallstreetformainstreet.com, that's wallstreetformainst.com website, where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.